Okay, so you want to own a skyscraper, not just a building, the building. The one that dominates the skyline, the one tourists photograph from the street, with their necks craned all the way back. The one with your name on the lobby wall in brushed steel letters 3 feet tall. You picture yourself at the top floor, looking down at a city that suddenly seems small and manageable, like something you could hold in your hand. You picture rent checks rolling in from hundreds of tenants, month after month, forever, like a machine that just prints money as long as the sun comes up. A skyscraper feels like the ultimate trophy asset, permanent, prestigious, and profitable, the kind of thing that outlives you and puts your name in history books. That quote, the dream. Here's what actually happens. First, let's talk about how you actually get one of these things, because it is nothing like buying a house or even buying an apartment building. You don't walk into a bank and ask for a loan to build an 80-story tower the way you'd ask for a mortgage. Skyscrapers are built by consortiums, a lead developer, usually one or more institutional partners like a pension fund, an insurance company, or a sovereign wealth fund, and a syndicate of banks providing construction debt spread across multiple lenders, because no single bank wants that much exposure to one building. The entry ticket just to sit at that table with a credible proposal starts somewhere around $50 to $100 million in equity for a mid-sized tower in a major city. For the true giants, the super talls, the buildings pushing past 80 or 90 stories, you are looking at equity commitments in the hundreds of millions before a single beam goes up. The Burj Khalifa cost roughly $1.5 billion to build. One World Trade Center in New York came in around $3.9 billion once you count everything: construction, financing costs, security infrastructure, and years of delay. These are not numbers a wealthy individual writes on a personal check. This is institutional money, sovereign money, insurance company money, moving in enormous blocks, structured through layers of holding companies and special purpose entities designed specifically so that if the tower fails, the loss is contained and doesn't take down the parent company with it. And even getting to that number requires years of work before construction even starts. You need the land, which in a dense city core might itself cost more than the entire building did 50 years ago. A single acre in Midtown Manhattan or central Hong Kong can run into the hundreds of millions on its own. You need zoning approval and air rights. Sometimes you literally have to buy the unused development rights from the shorter building next door, just so you're legally allowed to build taller than the base zoning allows, a practice New York calls transferring air rights, and it can cost tens of millions of dollars just to buy permission to go higher. You need environmental review, traffic studies, wind tunnel testing to make sure your tower doesn't create dangerous downdrafts at street level, community board hearings, and sometimes lawsuits from neighborhood groups who don't want a 200-meter shadow falling across their park every afternoon at 3 o'clock. In cities like New York, London, or Hong Kong, this pre-construction phase alone can eat up 3, 4, even 5 years and tens of millions of dollars before you've poured a single foundation. Only after all of that do you get to start spending the real money. So that's how you get in the door. Now let's talk about what it actually costs to build the thing, because this is where the numbers stop looking like a business plan and start looking like a small nation's infrastructure budget. The rule of thumb developers use is that construction costs rise non-linearly with height, meaning the taller you go, the more expensive each additional square foot becomes, not just in total, but per unit. A 20-story building might cost around $300 per square foot to construct in a major Western city. Push that to 60 stories and you're looking at $500 to $600 per square foot, because now you need a completely different structural system. A reinforced concrete or steel core, wide enough and strong enough to resist wind sway that could otherwise make people on the top floors feel seasick. Elevators that operate in multiple zones because a single shaft simply cannot efficiently serve 100 floors of foot traffic. And entire mechanical floors, full stories dedicated to nothing but water pumps, generators, and air handling equipment, inserted every 20 or 30 floors, which is space you paid full construction price for, but can never rent out to a single tenant. push past 100 stories into true super tall territory, and costs can exceed $1,000 per square foot. The Burj Khalifa needed a specially engineered concrete mix that could be pumped over 600 meters vertically without the heavier aggregate separating from the cement paste under its own weight. That's an engineering problem nobody had fully solved at that scale before, and solving it cost real money and real time. One World Trade Center's final price tag worked out to somewhere around $2,000 per square foot when you fold in the reinforced concrete core designed to resist a direct vehicle impact, the blast-resistant base extending well below street level, and years of construction delays layered on top of an already complex design. And every year of delay isn't just lost time, it's compounding interest on construction loans that can run at 6, 7, 8%, sometimes higher depending on the era and the country. 9 years late, as happened, with more than one iconic tower project around the world, doesn't just mean 9 years of no rental income. It means 9 years of interest payments stacking on top of a loan that was already enormous, turning what looked like a $1.5 billion project on paper into a $2.5 billion project by the time the doors finally open. And here's the first trap. Almost nobody accounts for when they picture skyscraper ownership. The money goes out for years, sometimes a full decade, before any money comes back in. You are paying interest on construction debt starting from the moment you break ground, not from the moment tenants move in. You're paying property taxes on an empty shell, assessed at a value that assumes it will one day be full, whether it is or not. You're paying to keep idle cranes running, to keep the building lit, heated and pressurized during years of interior fit-out, to keep round-the-clock security protecting a half-finished structure that's already worth hundreds of millions of dollars on paper, but earns exactly zero. By the time the ribbon gets cut and your first tenant moves their furniture in, you may have already spent 5, 6, 7 years paying out money with not $1 of rent coming back. Developers call this the J-curve, a chart of cumulative cash flow that dives deep underwater before it ever climbs back above the line. And the deeper and longer that dive, the more equity gets consumed just staying alive before the building has produced a single cent of income. Some towers don't survive the dive. They run out of financing halfway up and simply stop. There are well-documented zombie towers scattered across cities from parts of the former Soviet Union to certain half-finished luxury towers in the Gulf that stood as empty concrete skeletons for over a decade because the money ran out before the concrete did, quietly rusting rebar exposed to the weather while lawyers argued over who owed what to whom. Now, before we get into how the building actually pays you back. And trust me, this is where it gets genuinely interesting, because the way skyscrapers really make money is not the way most people assume. Let me just say this. If you've made it this far, you already understand more about how these towers work than 90% of people who walk past one every single day without a second thought. And what's coming next, the actual revenue tricks, the hidden income streams that make some towers wildly profitable, while nearly identical towers a few blocks away limp along barely breaking even, that's the part nobody covers on the evening news. If you want to keep seeing exactly how these deals work behind the marble lobbies and the glass elevators, subscribe now, because we're about to get into the part of the story where fortunes are actually made or quietly wiped out. So how does a skyscraper actually make money? The obvious answer is rent. You lease out office floors or apartments or hotel rooms, and tenants pay you monthly. But office and residential rent is actually the slow, regulated, capped part of the business. In most major cities, commercial leases are long-term contracts, 10 or 15 years, with modest annual escalations, maybe 2 or 3% a year, sometimes tied to inflation indexes that can lag actual costs. It's stable, it's predictable, and lenders love it because it makes the debt service look safe on a spreadsheet. But it's not where the real margin lives. Office rent, on its own, largely covers your debt service, your property taxes, and your operating costs. It rarely, by itself, makes anyone genuinely rich. The real money in modern skyscrapers comes from the less obvious side of the business, the layers stacked on top of pure office or apartment rent. Retail space at street level can command rents 5 to 10 times higher per square foot than the offices 30 floors above, because a flagship store at the base of an iconic tower is effectively paying for advertising as much as for square footage. A luxury brand at the base of a famous tower gets photographed by every tourist who's ever stood in front of that building. Observation decks are an entire business unto themselves. The Empire State Building's observation deck alone generates well over $100 million a year in ticket revenue on a building where the actual office rents, though substantial, are almost an afterthought by comparison in terms of pure profit margin, because there's no tenant to negotiate with, no broker commission, no vacancy risk, just millions of tourists paying $30 or $40 each for a view. Naming rights and branding deals matter enormously too, where a bank or an insurance company pays tens of millions of dollars a year just to have its logo mounted on top of the building, lit up and visible from the highway, from the airport, from every postcard and skyline photo of that city for the next 50 years. Parking structures underneath the tower, restaurants at height, charging dramatically inflated menu prices justified purely by the view rather than the food, event space rental for weddings and corporate galas on the top floors that can charge tens of thousands of dollars for a single evening, and broadcast antenna leases to television and telecom companies who pay handsomely for that valuable elevation above the rest of the city. Some of the most profitable towers in the world actually make more money from these ancillary, less regulated revenue streams than from the office leases that make up the overwhelming majority of their square footage. It's the same logic as an airline making more margin from baggage fees and seat upgrades than from the base ticket price. The obvious product is barely profitable, and the real margin quietly lives in the add-ons nobody thinks about when they picture the business dot. Now let's talk about a real case of this going badly wrong, because the failures here are just as instructive as the successes, maybe more so. Consider what happened across Dubai's skyline after the 2008 financial crisis. Property values in parts of the city fell by more than 50% within about 18 months. Towers that were sold off-plan to speculative investors at peak prices suddenly had owners who owed more on their unit than the unit was now worth, and many simply defaulted, walking away from deposits rather than continuing payments on a rapidly falling asset, leaving entire floors of half-finished luxury towers sitting empty for years while banks and developers fought over who would absorb the losses. Or consider 20 Fenchurch Street in London, nicknamed the walkie-talkie for its distinctive curved shape, which became infamous not for a financial collapse but for a physical design flaw. Its concave glass facade acted like a parabolic mirror, concentrating sunlight into a beam hot enough to melt car body panels and fry an egg on the pavement below, forcing the developer to spend millions of pounds retrofitting a permanent sunshade after the building was already complete, on top of compensation claims from shop and car owners affected in the surrounding streets. Or look back further at how many towers built during Japan's asset price bubble of the late 1980s ended up, decades later, worth only a fraction of their original construction cost once that bubble finally burst in the early 90s, sitting half-occupied for years while their owners quietly wrote down billions of yen in value on balance sheets nobody wanted to look at too closely. The lesson across all of these very different cases is the same. A skyscraper is a bet on an entire city's future, not just on one building's design or one developer's competence, and when that citywide bet goes wrong, it goes wrong at a scale that is very difficult to quietly walk away from now for the success story, because it's not all zombie towers and melted car doors. Look at Empire State Realty Trust, the entity that eventually took the Empire State Building public as a real estate investment trust. Even nearly a century after it first opened its doors, in 1931, the building generates hundreds of millions of dollars a year in total revenue. And that observation deck we mentioned earlier contributes a disproportionately large share of the operating profit relative to the tiny fraction of the building's total floor area it actually occupies, a few floors near the top, producing profit margins most office landlords could only dream of. Or look at the Shanghai Tower in China, standing over 2,000 feet tall, which was designed from day one around a genuinely mixed-use model: offices, a luxury hotel, retail space, and public observation decks all stacked together in distinct zones, specifically so that a downturn in any single revenue stream couldn't sink the whole project's economics at once. Diversification, in other words, isn't just an investment strategy for a stock portfolio sitting in a brokerage account. It's now baked directly into how the smartest modern super-tall towers are physically designed, floor by floor, zone by zone, from the earliest sketches. So what actually separates the towers that make fortunes from the towers that quietly become expensive monuments to bad timing? A few things consistently across every market we've looked at. Location matters more than height. A modest 50-story tower sitting in the beating heart of a dense, genuinely growing financial district will out-earn a flashy 100-story tower in a secondary city with weaker underlying demand, essentially every single time, no matter how impressive the second building looks in renderings. Diversification of tenants matters enormously. A tower anchored by one single massive corporate tenant looks efficient and low risk on the day it opens, fully leased in one signature. But if that tenant ever leaves, downsizes, or goes bankrupt, the entire building's cash flow can evaporate almost overnight, which is exactly the kind of concentration risk that has sunk more than one tower when a major anchor tenant restructured or simply relocated to a cheaper building across town. And timing matters enormously too, because skyscrapers take 5 to 10 years from initial concept to final completion, and the market you designed for at the very start is very often not the market you actually deliver into at the end. Office towers greenlit back in 2018 and 2019, for instance, opened their doors into a 2022 and 2023 world where remote work had permanently reduced office demand in many major cities, leaving brand new, architecturally stunning towers competing hard for a shrinking pool of tenants against half-empty older buildings sitting just a few blocks away, offering steep discounts. And that leads us straight into the trend shaping the entire industry right now, today. Post-pandemic office vacancy in major cities like San Francisco has at times exceeded 30%, a level not seen in decades, and that has forced a genuine structural reckoning in how skyscrapers get financed and designed going forward. Developers today build far more mixed-use towers than they did 15 years ago, deliberately blending office space, luxury residential units, hotel rooms, and retail into a single structure, specifically so that weakness in one sector doesn't sink the entire building's economics the way a single-use office tower can be sunk. There's also a growing wave of office-to-residential conversions happening right now, where aging or half-empty office towers are being gutted internally and rebuilt as apartments. Technically, very challenging work because office floor plates are often too deep to give residential units good natural light and ventilation, but increasingly financially necessary in cities drowning in unused office square footage they can no longer lease at any price. And globally, the center of gravity for brand new, super tall construction has shifted decisively toward the Middle East and Asia. Saudi Arabia's Jeddah Tower, aiming to be the first structure in the world to break 1 full kilometer in height, along with various new super talls across China and India, are where the truly enormous new capital commitments are actually happening right now, while construction of brand new super talls across North America and Europe has slowed down considerably by comparison over the past several years. So, let's land the plane. There are 2 honest ways this story ends. If you actually manage to build or acquire your own skyscraper. The optimistic scenario, your tower lands in a genuinely growing city, is well diversified across office, retail, hospitality, and observation revenue, gets fully leased within 3 to 5 years of opening, and over a 20 or 30-year hold generates the kind of steady 8 to 12% annual return that makes institutional investors, like pension funds, very happy, indeed slow, unglamorous, utterly boring on a spreadsheet, but real wealth compounding quietly for decades on end. The realistic scenario, and the one that happens far more often than any glossy architectural rendering would ever suggest. Construction runs years and hundreds of millions of dollars over budget. The market shifts before you even finish building. You spend the first decade of ownership essentially breaking even, or worse, just servicing the debt. and the building only becomes genuinely, meaningfully profitable once it's been fully depreciated and largely paid off, 25 or 30 years down the line, if it ever fully gets there at all. Here, quote, "The honest truth sitting underneath all of it, you are not buying a skyscraper. You are buying a 30-year bet on the future of an entire city wrapped in glass and steel and dressed up to look, for a little while, like a building."